Hello everyone, it's Professor Reiko here again, and today we are continuing on in our current liability contingency chapter, but now we're switching gears to kind of the second part of the chapter that focuses on contingencies. All right, so what is a contingency? Well, it's an existing condition, situation, or set of circumstances involving uncertainty as to the possible gains or losses that will be resolved when future events occur or fail to occur. So I'm kind of underlining the key terms. All right, so if you think about the other videos that we looked at from the first half on the current liability side of things, we knew those were all known dollar amounts. Now, if you look here, we have uncertainty, possible gains or losses, future events might happen. All right, so these are more amounts that we're going to estimate because they're based on some uncertainty of the future. All right, so gain contingencies are claims or rights to receive assets whose existence is uncertain, but which may become valid eventually. Okay, for the general rule on this, do not recognize gain contingencies until realized. Okay, that's just part of conservative accounting. We'll deal with losses, but we're not going to recognize the gains until we realize them. And then we might disclose them if there's a high probability. All right, so what we're going to focus on for the rest of it is loss contingencies. All right, so these involve possible future losses. A liability recorded as a result of future losses are contingent liabilities. All right, these are potential liabilities that may become, so you can see all these words, there's uncertainty, may become liabilities depending on the outcome of a future event. All right, so our three words, and once again, anytime you see something like this, think multiple choice question because it's a great place to ask them. All right, so if it is probable or likely, they should be recorded as if they are actual liabilities, if they are reasonably estimated. Reasonably possible is our middle ground. It's a contingent should be disclosed. The liability should be disclosed in the footnotes to the financial statements. And if it's remote, we don't do anything with them until the actual transaction occurs. All right, so what we're going to do the rest of the time is go through some common loss contingencies. All right, so an easy one to talk about is litigation. All right, so lawsuits. All right, so companies are getting sued all the time. So the key things here must have occurred on or before the financial statement date. Must have a probable unfavorable outcome. I mean, unfavorable because we're dealing with losses. It must be reasonably estimated. Okay, so you can see that probable is the same probable as up here. That's what we're talking about, and it must be estimated. All right, another one is consideration. It's called consideration payable. Now, all books, some books cover different things. So, depending on what your teacher covers in class, make sure, you focus in on that. These are, think of coupons, rebates. A lot of times, if you go buy something, you get a rebate. You have to basically send in your receipt and send in like the UPC code on the or UPC thing on the package and fill out some form, and they'll send you a check like 4 weeks later. All right, so that's a rebate. All right, so these are all liabilities to the company, but they don't know how much, how many people are actually going to use coupons or redeem the rebates and so forth. All right, so basically the rules here are charge the cost of each to an expense account in the period of the sale that benefits from the plan. May not be the same period the plan was offered. The charged amount goes to premium expense, so that's going to be our debit. And the estimated outstanding amounts are the premium liability. So I'm not going to do an example here because, it depends on what book you're using, if this is even covered, and it may not even be covered in that much detail by your teacher. So if it is, you might want to spend a little extra time on that. All right, other two common ones are warranties. All right, we're going to do a whole separate video on warranty, and then asset retirement obligations, which we'll also do a video on that. One thing I want to point out here, so this is chapter 13 in both the Spiceland and the Kiso book. However, asset retirement obligations in the Spiceland book, they're in the fixed asset chapter, which, that's an E, the fixed asset chapter, because it's dealing with the retirement of an asset. And I believe that might be chapter 10 or 11. So depending on that, so I put that in a separate video. So if you're in the Spiceland book, it's going to be with your assets. If you're with your Kiso book, it's here in chapter 13. So I just wanted to point that out. All right, so our next two videos, one will be on warranties and one on asset retirement obligations, and then that will wrap up our chapter on current liabilities and contingencies. So this video is a little bit shorter. We just want to define contingencies, make sure we understand what those are, and now we'll focus in on a couple of the main main ones with warranties and asset retirement obligations. So I'll make sure you tune in for those because the warranty one especially could potentially be a problem on your test depending on how your teacher covers it, because there's a couple of different types of warranties, so it makes for a good test question. All right, so I'll see you next time. Hope you're enjoying. Please share as always. Thank you.